In this video, we'll first explain how liquidity influences price movements, how to mark key liquidity levels on the chart, and finally, how to use liquidity concepts in your setups with multiple chart examples. Levels are areas on the chart where a high concentration of orders, like stop losses or pending trades, are likely to exist. These levels act as magnets for price, drawing it toward them before a major move occurs. Imagine if this is our recent price action. We know that if the price pulls back to this level, many price action traders will go long and put their stop losses below this level to benefit from the bull market. If the price continues to move higher and approaches the swing high, traders mark it as their target and take profits or even go short at the resistance area. Therefore, we have liquidity below the swing lows and above the swing highs, which we refer as buy-side and sell-side liquidity. So liquidity above a high or a group of highs represents buy-side liquidity. When the price approaches this level, the bearish traders will go short, or they protect their previously opened short positions. On the other hand, the breakout traders will go long if the price breaks through this level. The sudden price movement designed to grab this liquidity is called buy-side delivery. It runs higher to engage the liquidity above these equal highs. In this case, the algorithmic price delivery traps traders on both sides, engaging liquidity before smart money takes control and goes short. Similarly, liquidity below a low or a group of lows represents sell-side liquidity. Just like in the bullish scenario, when the price gets close to this level, bullish traders might go long or protect their previously opened long positions. On the other hand, breakout traders may go short if the price breaks below this level. The sudden price movement designed to grab this liquidity is called sell-side delivery. In this case, the algorithmic price delivery traps traders on both sides, engaging the liquidity. After this, smart money typically goes long to target the buy-side liquidity. An important point to note is that the market tends to move away from levels where liquidity has recently been swept. On the other hand, it tends to move toward levels that still contain liquidity. Imagine this line chart as the market movements. When the market sentiment is bullish, sell-side liquidities are more important than buy-side liquidity. This is because sweeping the liquidity below these lows often signals a possible bullish continuation and creates an opportunity to go long in line with the dominant trend. Now let's talk about the key liquidity types you need to mark on the chart. Number 1. Swing highs and swing lows. We've mentioned these terms many times, but what do they actually refer to? Swings are price turning points where 3 candles form a specific price pattern. A swing high is a candle that creates a high, but the candles before and after it have lower highs and lower lows than the middle candle. Similarly, a swing low is a candle that creates a low, but the candles before and after it have higher lows and higher highs than the middle candle. The pattern is complete when the third candle closes. In this example, these are our identifiable swing highs and lows. Keep in mind that you can also use a 5-candle swing pattern, which can make our swings more powerful and reliable. But to understand why these swing points are important, you need to understand the psychology behind them. If someone wanted to buy this pair here, they are more likely to place their stop loss below this area to protect themselves from market fluctuations. Similarly, if someone wanted to sell here, their stop loss is more likely to be above this candle. On the other hand, breakout traders will open positions if these levels are violated. With that in mind, we know that the buy-side liquidity rests above this high, and sell-side liquidity rests below this swing low. Now how do we incorporate this concept into our trades? If we are bullish, creating swing lows before tapping into the demand area could be a great confirmation that we will see the bullish movements we want in the market. This is because the market has the opportunity to absorb the required fuel for future moves. If it does not gather enough liquidity, it might drop lower to collect more sell-side liquidity before continuing with bullish movement. The same concept applies to the bearish scenario. If we are bearish, creating swing highs along the way to a supply zone could be a great confirmation of a good trading opportunity. Now let's move on to the second type of liquidity. But before we continue, if you're looking for a platform to assist you with technical and fundamental analysis in your trades, As the name suggests, the price forms equal lows where the low points are around the same level. Similarly, the price forms equal highs where the highs are around the same level. So what does this signify in terms of price action? Double or triple bottoms created on the chart are great places to look for trading opportunities. Many retail traders expect rejection to the upside once the price taps into this area again. So they enter long positions at these levels, placing their stop losses somewhere below. However, as we mentioned earlier, smart money aims to trigger these stop losses. Therefore, it's important to wait for the liquidity to be collected before entering the market. If a demand area exists below the equal lows, there's a high chance the price will break below, sweep the liquidity, and then push higher. This is one of the key trading patterns in smart money concepts. Waiting for the price to collect retail traders' stop losses, and then entering the market at the demand area. The same scenario applies in a bearish market. When the price taps into the resistance area, retail traders go short, expecting a rejection to the downside. Their stop losses will be placed above the zone, gathering a lot of liquidity. If smart money wants to sell, they push the price above this resistance area to grab the liquidity, and then drive the price back down in the original bearish direction. As smart money traders, we enter after the stop losses have been swept. Let's take a look at some real chart examples. On the gold 30-minute chart, we have a clear uptrend, and a recent level of support has rejected the price multiple times. When the price approaches this level, many traders will go long, expecting another rejection. At the same time, traders who entered long positions earlier will be supporting their positions. This area becomes a key liquidity level where stop losses are gathered below. So, where can we enter as smart money traders? Looking to the left-hand side of the chart, we notice a fair value gap, which is an extreme demand zone. This provides a perfect opportunity to place a buy limit order at this zone, with the stop loss set below the zone. After sweeping the liquidity, the price rejects the FVG zone and pushes higher, just as expected. However, as you trade live in the markets, you'll undoubtedly experience losing trades or missed opportunities. This is why it's essential to follow your trading setup rules and risk management plan to capitalize on winning opportunities. Remember, trading is all about the future, and the future is inherently unpredictable. On the Euro-Dollar 15-minute chart, we see a strong uptrend, with the latest impulsive move creating equal lows. This will act as support when the price taps into this zone again. Below these equal lows lies a lot of liquidity. To the left, we can also spot fair value gaps, which will act as strong demand areas just below the liquidity zone. A perfect trading setup would be to wait for the price to break below the equal lows, grab the liquidity, and then go long at the FVG zone. You might ask, doesn't breaking below this area indicate a change of character and a shift in market direction? Yes, normally that would be considered a change of character, signaling that the market is no longer bullish. However, in this scenario, the change of character is invalid due to the liquidity concept. Sometimes, market structure levels become less significant when combined with liquidity concepts. Liquidity and market structure are inseparable in smart money trading. Let's talk about the next key liquidity zone. Turning points. Turning points are areas on the chart where the price shifts direction after a long-term trend. These levels are often viewed by the market as overbought or oversold, which increases the likelihood of a price reaction when revisited. They hold significant liquidity because they attract attention from both retail and institutional traders. The importance of turning points can be summarized in three key aspects: the accumulation of stop-loss orders, their psychological significance, and the tactics used by market makers to manipulate price around these levels. To effectively use this concept in trading, start by identifying key turning points. These are areas where the price has reversed sharply in the past, and are likely to hold clusters of stop-loss orders or pending orders. Next, wait for a liquidity grab below the turning point. This often appears as a spike beyond the turning point, where stop-loss orders are triggered, followed by a sharp reversal. Once you've identified a potential trade, wait for signs of reversal after the liquidity sweep, such as a long bullish momentum candlestick or change of character in the market. Enter the trade in the direction of the reversal. Set your stop loss just beyond the liquidity sweep to protect your position from further unexpected moves. For take profit levels, target the next significant support or resistance level, or consider Fibonacci retracement levels for additional precision. By using these steps, you can effectively incorporate turning points and their associated liquidity dynamics into your trading strategy. Daily high and low. Daily highs and lows are important levels on the chart in terms of liquidity. The daily high is the highest price reached during the day, and the daily low is the lowest price. These levels often attract a lot of attention from traders, with many placing their stop-loss orders or pending orders around these areas, making them full of liquidity. For traders using smart money concepts, these levels can present great opportunities. When the price gets close to the daily high, it might quickly move above it before coming back down. This movement takes out stop losses from traders who were selling and can activate buy orders. A similar situation happens near the daily low, where stop losses from buying trades get triggered. To use this in your trading, start by marking the daily high or low on your chart. Watch how the price behaves when it gets close to these levels. Often the price will briefly break through the daily high or low, and then reverse direction. This is your chance to plan a trade. You should also look for other confirmation signals, like if the daily high coincides with a change of character or reversal patterns. Check the overall trend to ensure you're trading in the same direction. When you see the price reverse after breaking the daily high or low, you can enter the trade in a new direction. Place your stop loss just beyond the level where the price broke out. For take profit, target the next key level on the chart, such as a support or resistance area. By using daily highs and lows as part of your trading plan, you can take advantage of these key price levels and increase your chances of making successful trades. So guys, I hope this video provided you with value.